Chapter 11, Current Liabilities and Payroll. All companies have debts and obligations that represent claims of outside parties against the assets of the company. These debts and obligations are referred to as liabilities. Included in these obligations are amounts borrowed from banks, unpaid bills, accrued obligations, and obligations that are contingent upon the outcome of some future event, like maybe a lawsuit. Generally, liabilities can be divided into current liabilities and long-term liabilities. Current liabilities are those obligations that must be fulfilled within 1 year or one operating cycle, whichever is longer. Long-term liabilities include any obligations that are due and payable outside that 1 year period or one operating cycle. Examples of current liabilities include accounts payable. These generally arise when a company engages in commerce on account with another business. Often, accounts payable are evidenced by the presence of a bill from the other party that includes the amount owed and the date on which payment is due. Buying inventory from a supplier, having a contract with the local power company to provide for electricity, or using services of a professional who bills periodically are all examples of transactions that can generate bills that are classified as accounts payable. Sales taxes payable. When goods are sold to customers, the state may require that the seller also collect sales taxes that are legally required to be paid by the consumer. Once collected, those sales tax amounts become payable to the state. Failure to forward the sales tax collected to the state in a timely fashion can result in indictment, fines, and even jail time. Unearned revenues. As discussed earlier, unearned revenues arise when a customer sends the company payment in advance of the company delivering a product or performing a service. Often this is described as a down payment or a deposit. This is common in businesses that want to make sure that customers do not order goods and then back out of the transaction. In addition, by requiring payment in advance, the company is better able to evaluate the amount of goods that will need to be produced. Then we have short-term notes payable. It is common in business for companies to borrow money on a very short term, for example, 90 or 180 days. This can occur when a company is anticipating payment but has cash disbursement obligations that are coming due before the payment is due to arrive. For this triad exercise, on August 10th, Swanson Company makes sales on account of $4,000 that are subject to a 4% sales tax. Record the entry for the sale. The entry will require a debit to accounts receivable for $4,160, the amount of the sale and the amount of the related sales tax. In addition, there will be credit to sales for $4,000 and a credit to sales tax payable for $160. Remember, once Swanson Company collects the sales tax, those sales tax amounts are payable to the state. On September 30th, Swanson Company makes a payment of $500 to the state to remit sales taxes they have collected during the month. Record the entry for the payment. The entry will require a debit to sales tax payable of $500 and a credit to cash for $500. A significant cost to any business is the cost of the company's employees. However, those employees are not paid continuously as they work. Typically, employees work for a period of time, 1 week, 2 weeks, or even 1 month, and then are paid at the end of the period for their work during that period. Until they are paid, the company has a liability that must be recorded. The deductions that are withheld from an employee's pay include old age, survivors, and disability insurance, otherwise referred to as Social Security, Medicare, federal income tax, state and local income taxes, and other various voluntary deductions. Federal income tax is withheld from the employee's pay and forwarded to the federal government on behalf of the employees. This creates a certain amount of efficiency. For example, if a company has 1,000 employees, it is much more efficient for the company to send a single check for all of the withholdings from all 1,000 employees than it would be for each employee to send in a separate check for their individual taxes. Some states and municipalities also collect income taxes. State income tax expenses can be as high as 7% of gross earnings. OASD, which was that old age and various other taxes that we talked about in this slide. That was old age, survivors, and disability insurance, which we commonly call Social Security. That's abbreviated as OASD, and Medicare taxes are also withheld from the employee's check. The OASD taxes are equal to 6.2% of the first $110,100 of income earned. OASD taxes are not computed on any income amounts in excess of $110,100. While the 6.2% amount has remained constant, except for periods when the federal government declares a payroll tax holiday, such as from 2009 until 2012, following the textbook writing, we are using 4.2% for OASD taxes. Medicare taxes are 1.45% of all earned income. In addition to the required withholdings, employees may elect to have additional amounts withheld for various reasons. Option withholdings include union dues, savings accounts, Christmas club accounts, pension contributions, health insurance premiums, life insurance premiums, or charities. Regardless of whether the withholding is mandated by government or an optional employee-requested withholding, the employer has an obligation to forward the payment to the appropriate designated party. At the end of each pay period, the company must make a journal entry to record the payment to employees and the payables related to the withholdings. For December, Smart Touch Learning records gross payroll of $28,580. Withholdings include $961 to OASD, $414 to Medicare, $5,716 to the IRS, $645 for health insurance premiums, and $60 to other voluntary withholdings. Record the payroll entry for December. So this is what it would look like. The entry will require a debit to salaries and wages expense for $28,580. The credits will be made to FICA OASD, FICA Medicare, income taxes payable, health insurance payable, other payables, and salaries and wages payable, as you can see from the example here. In addition to the withholdings from the employee's payroll, the companies themselves also must pay taxes as a consequence of having employees. There are two primary payroll taxes that all employers pay: a FICA match and unemployment compensation taxes. Any amounts withheld from employee paychecks must be matched by the employer. That's for the FICA match. For each employee, the company must pay, out of its own pocket, 7.65% of employee earnings up to $110,100 per employee. When earnings exceed $110,100 for each employee, the employer must pay 1.45% for Medicare. Unemployment is a fact of the U.S. economy. It is generally accepted that when an employee loses a job, through no fault of their own, they will receive unemployment checks for a specified period of time. Those checks come from Unemployment Insurance Fund. So where does this fund get the money to send out to unemployed workers? The money comes from unemployment taxes paid by every employer. Employers must pay 6.2% of the first $7,000 paid to each employee each year. Although the specific split differs from state to state, most states see 5.6% go to the state unemployment fund and 0.6% goes to the federal unemployment fund. In normal times, the funds paid in are sufficient to cover the amounts paid out. However, in times like the In times like when the American economy has experienced, such as in 2009, when there was high unemployment rates nationally, the funds had insufficient funds to make the necessary payments due to all of the eligible unemployed workers that were requesting payments. In such times, Congress will often authorize additional federal funds to be allocated to cover the deficiency. In December, Smart Touch Learning had wages subject to OASD of $22,880. Note that one employee went over the $110,100 threshold, so that not all of their salary was subject to OASD withholding. Wages subject to Medicare were $28,580. FUTA and SUTA, which are the unemployment taxes, were due on $4,000 of wages paid to a new employee. Prepare the journal entry to record the employer's payroll taxes. Well, this is what that would look like. The entry requires a debit to payroll tax expense for the total amount here, which is $2,081. There are also credits made to FICA OASD taxes payable, FICA Medicare taxes payable, FUTA payable, and SUTA payable. Any function related to cash disbursements is often a target for thieves and fraudsters. To lessen the likelihood of cash leakage from the system, strong internal controls should be in place. These controls include separation of duties between those who approve payroll, those who prepare the payroll checks, and those who distribute the payroll checks. Many companies require employees to present IDs before they can receive their paychecks. In addition, time clocks are used to verify hours worked, and direct deposit is used to make sure the checks are not going to fake employees. Some liabilities, such as bonus accruals or vacation and sick leave accruals, are estimates. In order to meet the requirements of the matching principle, companies record these expenses in the current period, even though the actual payment for those expenses may not occur for several months. In this triad exercise, O'Connor guarantees its vacuums for 4 years. O'Connor's experience indicates that warranty costs will be approximately 6% of sales. Assuming that O'Connor has sales of $200,000 during 2014, prepare the journal entry to record the warranty expense in the current period. Well, this is what that would look like. The entry requires a debit to warranty expense for $12,000, which is the $200,000 times 6%, and a credit to warranties payable of $12,000. In many cases, things happen currently that do not immediately create a liability, but that may lead to the creation of a liability in the future. For example, a lawsuit filed against the company today may not even be heard in court for several months and maybe even years. Any potential liability that depends on a future event is referred to as a contingent liability. Because the presence of a contingent liability embodies information that may impact the value of a company, the question arises as to how or when contingent liabilities should be disclosed to creditors and investors. In order to determine the form of disclosure that is required by any contingent liability, a two-step decision process is used. First, we ask how likely it is that the event that triggers a contingent liability will actually happen. For example, how likely is it that we will lose the lawsuit? Second, can the amount of the contingent liability be reasonably estimated? This table can be conveniently used to define the proper treatment for any contingent liability. For any contingent liability where the likelihood of a negative outcome is remote, there is no disclosure requirement under GAAP. If the likelihood of a negative outcome is probable and the amount of that contingent liability can be reasonably estimated, then the contingent liability must be recorded as an expense and a liability on the books of the company. All other situations require disclosure in the notes to the financial statements, but do not require the creation of an actual liability on the books. Other kinds of contingent liabilities include co-signing notes, lawsuits, guarantees, environmental cleanup costs, forward contracts, and contingent payments in an acquisition. Let's see if we can match the treatments with the likelihood of a future event. When the likelihood of a future event is reasonably possible, then the company must disclose the contingent liability in the notes to the financial statements. The times interest earned ratio is used to evaluate a business's ability to pay interest expense. The ratio is computed by adding net income, income tax expense, and interest expense, and then dividing that total by interest expense. An alternative way to state this ratio is to divide EBIT, or earnings before interest and taxes, by interest expense. Using data for Green Mountain, compute the times interest earned ratio for 2011. And this is what that looks like. With 6.22, rounding, of course, to the nearest thousandth there, or hundredth, sorry, 6.22 would be your answer.